Welcome back, everybody. It is Tuesday night, and this is Vetted VA Live. I get to interview and talk to and have conversations with vetted pros on both sides of the aisle. Tonight, we have only lenders. We don't have any of our real estate experts with us tonight, but we're going to go through a little different flavor. We oftentimes on the show go through the questions, go through a topic in more detail, and tonight we're going to go through sort of a grab bag of questions, the most common questions that have been coming up in the Vetted VA group on Facebook. If you are not currently a member, if you're seeing this out on YouTube, you're not aware of the group, you are a veteran, you want to get your questions about mortgage and real estate answered, basically there's someone in there almost 24 hours a day, 7 days a week, even on holidays, there and prepared to answer your questions. So go check out Vetted VA on Facebook if you're not already a member. If you're watching in Facebook, you obviously are. Maybe go out to the YouTube channel and subscribe there, because there is some video content that goes out on the Vetted VA YouTube channel that doesn't always make its way into the group. So with that, I am joined by Mike Alberico in North Carolina, Randy Teakle in Salina, Texas, and Jerry Avila. Are you in Phoenix? What city are you in Arizona, Jerry?
I'm in California, actually.
Oh, you're back in California. I got it completely wrong.
No, you're good, bro. I bounced from California to Arizona, to the Phoenix area, back to California. So I'm
so
back.
When it's not 120 degrees, you're in Phoenix, and when it is 120 degrees, you're in California. Is that how it works?
You know what, bro? That's not a bad concept of what to follow. Yeah, because this time of year in Phoenix, it's not cold at all. Here, it's kind of chilly. Chilly for me, right? Because this is California, but like we're talking about 40s. It sometimes gets cold, so I'm good there.
I was talking to someone that just moved from Minnesota to Arizona yesterday, and they were like, "This is nothing. Like the coldest it could ever get would be a warm day for us in Minnesota. So no worries there." All right. Well, hopefully all of you watching at home are in a wonderful, warm place. We're going to just go through a bunch of questions that we have coming up in the group. And Mike, let's start with you, and we'll start with this one. I was denied by one lender. Does that mean that I can't be approved by a new lender? This is often a question that we get because there's this idea that it's the VA that's denying you, and all of these loans go back through VA. So if one lender, if you talk to a broker, you talk to a bank, you talk to an online lender, if one lender declines your loan, does that mean you're just dead in the water?
Not at all. And our internal industry term for these is called rescue loans. And I know that the Vetted VA pros have been through quite a few rescue loans. And what I mean by that is it was denied, like you said, by one person. We take a second look at it and figure out what we can do to fix it, make sure, we're in compliance and everything lines up. But the biggest thing is, especially with VA loans, is the VA handbook is very broad, meaning there's not a lot of specifics on each individual subject, which is good and bad. Good is that there's lots of room for interpretation. Bad is there's lots of room for interpretation, and other lenders can put in what are called overlays. And what an overlay is, and anybody that's watched these lives before has seen us talk about overlays. VA doesn't have a minimum credit score, but certain lenders might have a 620 minimum or a 580. I've even seen some VA lenders want a 660. That's an example of an overlay, meaning VA has one set of rules. Us as a lender are going to put in another set of rules. So the reason I bring that up is you may have been declined for an overlay, and you can go to a different lender that has more flexibility in the VA loan program. Another potential reason is we're all humans in this business. Somebody might have made a mistake, and you might have to get creative. Like I had one where it's like, oh, we can just pay off this small debt, or we can bring in your TSP and get terms of withdrawal and just use as reserves. We didn't even have to do the withdrawal from there. It's just showing strength in making sure we meet residual income as well as our automated approval, or even switch into a manual underwrite. There's lots of ways to look at this, and it goes on all programs, not just VA.
So with that, the thing I was going to say is you covered it really well there, is the two biggest reasons that we probably see for this are loan officer incompetence, either just not knowing how to structure the file, or overlays. Jerry, you see anything besides overlays where someone goes to a lender, one of the big online lenders? Some of them are limited to 45 or a 50 debt to income ratio, despite the fact that the VA doesn't have it. Besides overlays and just general lender incompetence, whether that's the originator, the processor, the underwriter, any other things that you see that would cause you to potentially get declined where you could get approved from another lender?
Okay, so one of the things that I ended up going through just recently, which I just posted one today about a story of a veteran's situation where they went to one of these veteran-friendly lenders, and they basically told them, "Yeah, you know what? We'll help you out with the refinance, compared, and just like we do here in the group, what we did is cost compare the two estimates, and we said, okay, no, it's a good deal. Stick with them, stay there, because this was quoted 2 weeks ago. I'm here today. This isn't going to match. Like you're better off sticking with them, right?" And sadly, the advice that they got while under contract for a refinance on they were doing a cash out. The poor veteran ended up being told, don't make your payments on your credit cards because we don't want our payoffs changing and having to pull new payoffs. And don't pay your mortgage payment because that's going to change that payoff as well on the mortgage. And now we're going to have to, pay the cost of a new payoff. And at the end of everything, they pushed out their close of escrow, and then they pushed it off again. They pushed it off again, and all over the fact that they basically waited around until that credit got shot by having a bunch of 30-day lates, and it ultimately ended up costing them the loan. So what happened? Just like what was just said, all of a sudden it becomes a rescue loan, and we have to try to find the best suited lenders that are going to be able to have no overlays or limited overlays that would be willing to take that on, knowing that it's a 30-day late and it's going to remain late, even though we're at that, we're already 30 days late and they can't make the mortgage payments because they use that to pay other debts. Those are the type of scenarios that I come across that unfortunately I have to, sometimes really search deeply into every single lender that we utilize and find out who can actually do the loan. But those are the type of incompetent, processes that you sometimes see from some of these, like you were saying, some of these phone center jockeys that we come across, that unfortunately they will tell them whatever they want and there's no repercussions. Nobody pays the consequences other than the veteran. And that's the thing I've seen. So I'm sorry, I get a little agitated with that situation, but it took me 30 days, but we got it done.
Well, Randy, maybe walk us through that. So one of the biggest industry trade groups for us, they have a tagline that brokers are better. Brokers can be better. Brokers are often better. They're not always better, but this is a situation where we're talking about overlays. What are some of the benefits of coming to you as a broker versus going to one of those online lenders where they have a set rate sheet and a defined set of guidelines?
So a couple of things. First, from that first question, I would say the biggest thing for me is communication. And when I get someone referred to me or someone calls me, sets an appointment, whatever, the first thing I do is schedule them for a 45-minute appointment just to visit with them and fully understand from the 30,000-foot view down to the micro view what their situation is, what their goals are, what they're trying to do. And I think that so many times in that there's stuff that comes up that if you're in as Jerry said, a desk jockey position, a lot of those jobs are compensated based on how many applications they take every day. They're compensated by, hourly and very basic applications. The more that they do, the more that they make, et cetera. And I'd say that's an advantage for a broker in that my big goal when I meet people is to have them, when they walk away from everything, being a 5-star review raving fan. And so if I'm doing that, it's not only because I price better, because I do have 43 different lenders that my brokerage is set up with. And I price out using the tools that we have where you can put the scenario in, and then whoever has the appetite for it is going to, and that changes day to day, lender to lender based on their workload, etc. Whoever has the appetite that I know is going to be a great operator, execute on time, etc. That's who I'm going to work with. But I think the big thing is communicating and understanding that view. And so many times there's stuff that comes out. Like I just got referred a deal that she says, I've been turned down by 2 people. And I said, well, what's your situation? And they basically, her big issue was that they were going to have their husband is going to stay in the California, and they're moving to Texas to be near family, etc. And the husband's going to stay there, and they were told that his income couldn't be used because he was staying there, and it's absolutely not true. Obviously, we're going to budget for his rental, his living expenses to stay there, and the plan is that he's with the DOD. And he's going to put in for transfers when positions come open. And the Texas location is ultimately their retirement spot. But the wife and children are going to take that residency now and fulfill that piece of it. And we're going to use his income. We're going to use the additional expenses. But 2 different lenders told him that wasn't possible. And they both sounded like they knew what they were talking about, because they said that's only that occupancy thing is only for people that are active duty. And so they kind of knew what, some scenario stuff. So they kind of sounded like they were doing, but they were wrong. And so I think that's the biggest thing, is to fully understand, number one, the guidelines, and then fully communicate what the situation was. I just had another deal that was a little bit out of the ordinary that we just funded last Monday. And it was a deal where was a professional. He was actually an orthodontist, and he was moving again from California to Texas. Was currently working full time in California. The wife was working full time, and both as orthodontists. The wife didn't have a job here. He had a job with a contract that was technically part time, but it was part time at his part-time guaranteed pay was $16,000 a month.
Can I get that job? Where do they take resumes? I would like a part-time $16,000.
Well, you got to do the 20 years of education first, and everything that goes with that. But the bottom line is he was denied by 4 different lenders that told him that they couldn't do the loan because it was variable income that had to have a 2-year history before they could use it. But the contract was very, very clear that he had a minimum compensation in the part-time work of almost $16,000 a month before other people turned him down because it didn't meet the guidelines. So those guys knew a little bit about guidelines, knew that it was variable income, knew that you needed 2 years, but didn't know that. And the funny thing about this was about a 7% DTI when it was all set, because the wife had. Both of them had 100% P&T, so they had the fixed income coming in, and then he had the $16,000 part-time income coming in. So the DTI was really simple. They had about twice what the purchase price was in assets as well. And so there's just no way in the world that if it were my personal money, I would have done it in a heartbeat. But they've been turned down by 4 people. So again, it's communication, and then knowing. And then in my case, I said, yeah, you've been turned down by 4 different people. I don't see a problem with it. Let me just give me a minute, and I'll make sure, run it by an underwriter. And an hour later, I had confirmation that I wasn't crazy. And the loan funded last Monday. So,
and again, that is the benefit of being a broker. All 4 of us are brokers, so that ability, because there are times when we'll call our preferred lender and they go, "Oh no, you can't do that." but we've got 3 others that will. So there's 2 pieces to it. And the next question is kind of about shopping. But what I will say is, for us, because that's what we do as brokers, is we shop for you. But sometimes the shopping is not for the absolute rock bottom lowest interest rate. It's who in the heck will do that loan, or who can wrap their mind around it and not pigeonhole you into just a little box. So with that, we have, why are my questions not working here? There we go. This question comes up a lot because people will go online, they read articles, they see videos, and they say, hey, you have to shop for your mortgage. You can't just go with the first lender that you talk to, which is generally good advice. But we do get to a point, you shouldn't call 50 lenders. So Mike, why don't you kick us off with how many lenders should someone get quotes from? And what does getting a quote mean? Does it mean they're going through the full application process, having their credit pulled by 10 different lenders? If you were recommending to a friend or family member that's in a state where you couldn't do the loan and pretend that you didn't have a friend there, which I know you do, that you could refer them to, what would you tell them to do in terms of shopping?
Well, I mean, if you're in North Carolina, there's only one stop. It's me. Joking, guys. Do your due diligence. You can always find something cheaper online. That's just the nature of everything. I don't care if you're looking at cars, you're looking at a hat, anything. You can always find it cheaper online, but you got to weigh more than one option. You got to not only just shop these different individuals for rates, you have to kind of interview them as well, because you want to see how long they've been licensed. I get it. Everybody has to start somewhere. I started in this business in 2012. I sat on my boss's desk for 6 months to learn. A lot of companies will just throw them right out on the floor, and that's where, kind of like the previous topic, mistakes get made. So especially when utilizing the VA loan is, not only what's your rate, but how much experience do you have with the VA loan? Questions like that go a long way, because then down the road you can avoid the rescue situation as well. But directly, I would say, maybe 3 to 5 lenders, depending on how deep you want to dive into it. And one thing that is important is what you were talking about, going through the full process and everything like that, is credit reports are expensive now. A lot of lenders will charge you up front for them. That's an individual lender choice, and they're going to go up again, unfortunately, in 2025. So if you get your credit checked once and get pre-approved, that's great. That's the one thing you definitely want to do before submitting any offers. But if you're going down the shopping path, you can always just reach out and ask for quotes. And what I always tell them is be direct. Like, my response when I'm looking for rates, I have lots of people from inside our group, veterans and active duty personnel, reach out to me and say, hey, I'm shopping around for options. All right, give me your credit score, your sales price. Did you already get pre-approved? I mean, if they're not, that's a whole different conversation. That's when you schedule a call like Randy was talking about. But just looking at quotes, credit score, are you exempt? What's your sales price, etc.? And we can put together options for you. One thing that I do, and I know a lot of folks don't do it, and a lot of people are actually hesitant on sharing info from other lenders because they either think that they're showing their hand, for lack of a better term, or like, I'm going to undercut them. Well, as a broker, it's very challenging on VA to undercut, because we have set compensation plans and the VA has rules in place for going in another compensation method. But the reason I bring that up is, I'm getting 5.625 from the guy down the street, Mike. You're at 5.999. Well, let me see that loan estimate or cost sheet, fee sheet, back of the napkin, whatever. I need to look at whatever fees are involved there. And we've all ran into situations like that from a professional standpoint. I'm sure a lot of people have ran into it from a consumer standpoint. Rate is not always the only factor. In that particular situation, I could have got them down to 5.625, cheaper than the other lender was offering. But then I explained the break-even points of taking that 599 versus the 5.625. So it's going to take you 62 payments. Let's round down 5 years. Are you going to be in this property 5 years? Is there going to be an opportunity to refinance, etc.? So shopping, yes, find your lenders. Like I said, it's not set in stone, like 3 to 5 lenders, but also make sure you're shopping correctly, looking at the fees in box A and B. That's all that we control. And looking at different rate options. a lot of times, and I know I've said this to you before, Josh, on these lives, the lowest rate is not always the best.
Absolutely. Jerry, how do you answer that question? If someone's saying, hey, great, I got your number, but I need to talk to X number of lenders, or how many other quotes do you think I need to get? And the funny thing is, I'm a cosign on what Mike said. I know, the four of us know that if someone calls us, they're not going to get the rock bottom lowest rate on earth, but they're going to get a really competitive interest rate with years of knowledge and expertise and not have to be rescued. So it's easy, but also somewhat self-serving to say, you don't need to shop, but we're going to assume that you don't know that. If I'm your first call, you don't know that Mike was the greatest. I'm the greatest. So from that perspective, Jerry, where do you go with that conversation?
So those conversations tend to go more in, well, at least for me, in the direction of, okay, you have to think about the quality of the individual that you're working with. Because at the end of the day, sometimes the money is not necessarily the most important factor for most people, or for many people. It is, can you trust the individual you're working with? So I always tell everyone, like, it's not just the numbers. Like, yes, the numbers matter and the numbers are very important, but you got to make sure that the person you're talking to, that you're comfortable with, that you can be honest with them, and that they're honest with you in return, that you actually feel that the authenticity in where it's coming from. Because if you don't, then you're going to be second guessing every single thing they tell you, and every single thing that comes across, across for you to sign, right? And so at the end of the day, you want not only for them to have a good experience, but also have a positive outlook in regards to the process. So a lot of times I'll tell people, just, take a look at different lender platforms, right? Go broker, go retail, go to the Temus of the industry, like Rocket and stuff like that, right? If that's what you want to do. But at the end of the day, I look at it as like, where are you going to find the best service, rate, and integrity across the board, right? At the end of the day, it's where is it going to be an even keel situation to where you can feel comfortable versus you're going to be spikes and peaks, right? Like peaks and valleys. And all of a sudden, that's the last thing you want to be going through in an experience as a consumer. You want to have a positive experience where it's steady Eddie, right? You don't want these, like what the way rates have been over the last couple of years, right? Like you want it to be a steady process where they're comfortable, they understand what they're walking into, and that they're getting their questions answered. So are they meeting all those like needs of yours? If they are, move forward. If they're not, search for another. And that's where the shopping for me comes into play. I always tell them, look at one, but look at different models, and then go with the one that you feel most comfortable moving forward with, because that's going to make a big difference, especially when you're talking about cost, right? Because at the end of the day, cost is going to show a lot of times, especially when you're going between potential certain retail lenders, certain online lenders, and then the brokers and the communities.
Randy, I'm going to ask you similar questions. The next question up here, but a slightly different angle. Before I do that, I kind of want to put a bow on what you guys just said, kind of the way that I answer this question. The answer is more than one, right? If you only talk to one lender, you could be talking to the highest priced lender on the planet. You would have no point of comparison. And I will tell most people that the answer is less than five, because anyone that I've ever spoken to that's talked to five or more lenders is just confused the heck out of themselves. Like they don't know which end is up. So really the answer is 2, 3, 4, depending on what you want to do, and who should talk to more lenders. From my perspective, the people who can successfully do that are people who've been through the process many times. They're very comfortable with it. They don't need someone to walk them through a loan estimate. They know what box A is. They know what they're looking for. And I generally know that with the questions that they're asking me. And most of our borrowers don't fall into that category. So if you're on the newer end of the scale, you probably don't want to talk to any more than about 3 lenders. So what Jerry was saying is talk to them from 3 different channels. Like if you go talk to 3 brokers, those numbers are probably going to be really, really similar. Talk to a broker, talk to a bank. If it makes you happy, you bank with Chase or your local credit union and they do VA loans, talk to them, get that number. And if you want to call a Rocket because you saw them on the TV, cool. You've got 3 different channels. You're going to have 3 very different experiences. And then again, kind of what Jerry was saying is, it is important. you need and deserve to get a competitive interest rate with good fees. So now that you're going to do the comparison, you're going to have that, but that's only one part of the stool. Knowledge and expertise is equally important, especially if you know there's some hair on your file, there's some issues, you changed jobs, your credit is not perfect. So know yourself. If you're an 800 credit score borrower with a $200,000 salary, you've been in that job for 20 years, you got no debt and $100,000 in the bank, you can probably call whatever idiot lender you want on the planet because they're all going to be able to get it. So cool, put more weight on interest rate at that point if you don't value that. But sort of that last piece that I like to point out is, and this one can be tricky because it can get you in trouble, someone that you have a comfort level with. Just like Jerry was saying, you're going to be talking, and Randy said, hey, a 30, 45-minute conversation on the front end to get all the details out and on the table. So you need to have a comfort level with them. But what I will say, I'll throw one quick story in here. I have some clients that we're going to have their docs going out tomorrow that they found their lender on social media. And I go, okay, social media, where did you find it? Well, Instagram. I said, okay, Instagram videos are like 30 seconds. It's like, well, we really liked him. His videos were funny and we talked to him and he was nice. I'm like, well, cool. He's an idiot because there's like 4 things about your file that jump out at me immediately that should have been asked ahead of time. And they're just now coming out through the process. So I have no doubt that he has a great personality, comes across great on social media, and you had a wonderful conversation with him, but he didn't have that knowledge or expertise. So each of those 3 is really, really important. So Randy, I'm gonna ask you a question. If you have anything to add to that, by all means do, but we kind of get a version of this. You got interesting music going there.
Someone calling for a loan quote. No doubt.
Someone calling for a rescue. They need a rescue because
You need a rescue loan.
Hey, Josh, before you go to the next thing, the only thing I want to add to that is with us being in a volatile rate environment for over the last year, when you are shopping as a consumer, to make sure you're doing an apples to apples comparison, you have to get quotes from basically the same day, because rates from last Friday are not the same as the rates we have today. So you may be working with Jerry and then you call Randy and Randy's like, oh yeah, I'm like $2,000 better than Jerry today. Okay. But when did you quote it? And you might go back to Jerry and he's $1,000 better just because the market shifted and he's working with a different lender. So not to add more stress or anything to it, but you have to be shopping correctly as well, because
there's layers to that onion.
Yeah, 100%.
And you say layers to that onion. We'll throw another layer. And this is not to confuse you guys or make it sound like this is impossible, because it is not. But it is to tell you why it's important to get someone that you feel comfortable, that you can trust. I have a guy that we opened a new refinance this morning. Well, he called me in was in interest rates 2-3 months ago. And he sent over a loan approval. I'm like, your loan is approved. You have a full application. Why was this not locked? Well, my loan officer said rates were going to go lower. I'm like, well, they're already up like 0.375% from the bottom. Why was this not locked? Well, he just told me the rates were going to go lower. So the person that he had talked to, he talked to 4 or 5 different lenders. He went with the guy that got him the lowest quote. And then that genius didn't advise him that, hey, we probably need to make sure that we have this. And it was literally $700,000 loan. He's at 7.375. At the best levels, he could have done 6.125, no cost. And now we're looking at, over 6.5 with him paying his own loan costs. And we're lucky to have that, because a month or 2 ago, there was no loan there available for him. So it is not only important to get a good quote, but that you're dealing with someone. None of us have a crystal ball. Mike doesn't, Jerry doesn't, Randy doesn't, I don't. But we all have services. We all watch this, and we can tell you, when are the odds in your favor? When are they not in your favor? So when do we need to lock? When can we possibly give this a little room to run? And also helping you in determining what your risk tolerance level is with that. So again, Randy, by all means, feel free to add anything from your perspective on that. But a version of this question that we get a lot is, my realtor wants me to talk to their lender, or my realtor is really pushing me to get the loan from their lender. So as you're shopping and you're comparing, how much weight should you put on that, and where should that come in? Should you get a quote? Always get a quote from your realtor's lender, and what do you do with that?
Well, there's a couple of different aspects there. And one of the things, again, when we're talking about the benefits of brokers is when you have, like in my case, 43 different lenders, there's always the possibility. I'm a big lock it if you like it, because if we lock it today and rates go down drastically, then the fact that I'm a broker plugged into 43 lenders, that doesn't go unnoticed on the lender that I locked with, right? So typically that lender doesn't want to lose the business, because typically I could switch the whole file somewhere else if I needed to in order to take advantage of those rates that just dropped drastically. And so the lender that I'm with obviously knows that, and I don't want to do that to them. And there's a float down that's typically fairly aggressive in those situations. And so you don't really get hurt by locking that loan. And the old adage is basically that I never forget this, because I used to work as a lifeguard at a swimming pool, but turds float. And so I'm a big lock it. If it works for you, lock it. And then if something changes that it's not a competitive anymore, then we can always switch lenders if we need to, or renegotiate. And typically it has to really drop significantly for that renegotiation or the other to come into play, but you've got that available to you. As a broker, you don't lose that. And then at the same time, I was going to echo what Mike said there. Do everything in the same afternoon. You can talk to 3 different people over 3 different months, but when it comes down to the nitty gritty, and you've got a contract, you want to get that rolling right away, then get all the 3 quotes in the same time. And you shouldn't really have to jump through a lot of hoops to do the comparisons. I know we kind of touched on that already, but if you know your FICO score for sure, because someone's already pulled it and given you a copy of it, or verified the middle score, etc., you know your situation, etc., and you're fully qualified somewhere, that's your golden ticket. But you want to make sure that you're getting a good deal. You should be able to call someone like Jerry or Mike and say, hey, this is what I've got. This is my FICO score. Here's the box A that I'm getting. They're giving me the 9.3 rate, but they're giving me $12,000 in lender credit and et cetera. You can compare apples to apples to make that work. And it shouldn't be a big hoop, a big circus to do it. But at the same point in time, do it all at the same afternoon, and don't go to 15 different lenders, because you're wasting your time.
I think if they ever tell you that they can't even provide a loan estimate or a fee worksheet, just run. There's no point in even having another conversation, because at that point you're also looking at somebody who's trying to conceal something, because for them not to give you some sort of estimate of fees, estimate of loan, like a loan estimate, like that's a concern. Like you need to be able to be like, no, I'm sorry, I'll just pass.
Well, to co-sign on that, Jerry, the story that I was thinking of as he was talking is I have a client a podcast listener in Alabama reached out about a VA one-time close, very specific type of loan. Not everyone does them. The most important thing is you get someone that has expertise, but he had found 2 lenders that both claimed to have expertise in it. One gave him terms and the other one said, oh, I don't play the rate shopping game. I don't charge any box A fees. I'm going to cover your appraisal, but we're not playing that rate shopping. I said, just run. Like, the guy's telling you, I'm going to pay all these things for free, but I'm not going to tell you what I'm really going to charge. Like, no one likes, I mean, in a perfect world, we would all like to get paid $1 bajillion for as little work as possible. But the reality is, it's a competitive world. You're a well-qualified borrower. You want good terms, and I want to get paid fairly for my knowledge and expertise. And part of that is that we have to give you the ability to shop. So anyone that says, hey, I'm not going to give you that, they're just telling you, hey, I don't want to work with you.
Yep. And then one other thing that we've kind of touched on through this whole thing is the difference between a big box lender and brokers and other, what I would say, longer term individuals. Typically we're available different hours, because I remember when I started at my very first lender, they let me in at 9 o'clock and they ran me out at 4. And if you were to try to call me anytime after that, then you're going to get my voicemail, and I'll be back in at 9 o'clock the next morning. And a lot of times for our borrowers, that's not very convenient as far as accessibility goes. So that's a big part of having a good experience. And one of the big faults that my wife's told me for 35 years is that I answer the phone too often. But it's a big thing whenever the very basic part of what we do is answer the phone, and availability that goes with that. So part of that might be that you might get the very best price from whoever, but if it's a major skip trace to get them on the phone, again, watch yourself and be careful. So
sort of my last thought or 2 cents on that one is, what I like to tell people is, in the moment, the interest rate is critically important to you. You want, like, when we get on our inquiry forms on our website and say, hey, do you have any questions? And like, the number one, far and away, 10-to-1 margin common question is, I want to make sure I'm getting the lowest interest rate. But if I go back to someone 30 days, 60 days, 90 days after they closed, and I said, hey, do you remember what interest rate we got you? 1 out of 10 will remember. I mean, it is important. You deserve a competitive interest rate. Stick with that. I'm not changing and deviating from that in any way, but obsessing over something and being willing to overlook a professional that you feel like really gets you, understands your situation, and is available nights, weekends when you need to. And most people are super respectful. People don't want to interrupt my evening or my weekend, but if they need to, it's important that they're able to, especially in a tight market where, hey, maybe you need a pre-approval letter on a Sunday night to put a deal together. It's important that you're able to get a hold of someone. We had talked kind of about these overlays and addressed this a little bit during that overlay conversation. But what is the lowest credit score the VA will accept? And then let's kind of translate that to the real world. Cool. VA may say one thing, but what do the lenders and investors that we work with in general, what do they say? Mike, you want to take that one?
Yeah, that goes back to the overlay comment earlier. And I don't have 43 lenders. I want to know who does your renewals every year, Randy, but we can take that offline. That's nuts. I have only 14 at my small shop, but the lowest I have is 500. But that's just one of many factors. That's like the tire on a car. If we're talking about the loan application rolling down to the finish line, that is one factor of the credit score. Are the tires and wheels important on a vehicle? Absolutely. But it's only one thing. So there's other things involved there. The biggest thing that I see, the lowest I've ever gotten done personally in my career was a 532. And there was some extenuating circumstances that we proved with medical debt. But the biggest thing that I see when it comes to the credit score and a lender accepting it, because the VA doesn't have a credit score, is compensating factors. And they're not completely, some lenders do have them basically written out for you, but mainly it's, have you reestablished good credit? Because I've had people go through that were a little bit higher. They were still in the 500 range, but they may have had a foreclosure or something in the past or gone through a messy divorce, but they got their financial life back on track for the last 12 months and the score was improving. It just wasn't exactly where it needed to be. So like I was saying, score is one thing, but payment history does factor into that. Reserves factor into that. Debt to income ratio factor into that as well. You can have an 800 credit score, but if you have 6 cars financed and your debt to income ratio is 96%, that doesn't matter. If you have a 550 and you have recent clean payment history and your back end debt ratio is 35%, meaning you're not in a lot of debt, that is all factored in there. So I haven't seen anything below the low 5s. I don't know what Randy's seen. I've seen lots of success stories since I've been with VA the last however many years we've been doing this. So what's your lowest one there?
Randy, you did anything in that range? Anything lower than 530 or so?
Well, yeah, but I've actually done a 0 where they didn't have a FICO at all. So a no score, but it totally made sense. It was just one of those things that the folks had bought into a particular guru, if you will,
Methodology.
that says that you shouldn't have any credit, shouldn't live a blah blah. Interesting enough, the guy gets paid by a mortgage company to
Gets paid a lot by a call center lender that doesn't have very attractive terms so that they can afford to pay him and run the ads on his radio show.
But they had bought into that, hook and sinker, and were able to get one done that had no score. But for the most part, just to give you kind of an overall view, is the lenders that we have overlays on rates, and so I always tell people that basically the golden standard for FICO scores is about at 680 as far as pricing goes. And then that goes down in 20-point bands. So you've got 680, and then you got 660 to 679, and that's going to be priced a little bit worse. Then you go down the next band down, and then where all of my lenders will go to 620. So that's the minimum for some of them. I lose about half of them at 619. I lose another half of those at 599, and then I lose all but 5 at 570 or 559. So and it's just a handful that will go down to 500. But the folks that are in that range, when you get sub 600, that the biggest factor, like Mike said, is going to be what your overall situation is, and your ability as an originator to paint a story to an underwriter that says those problems that were causing the slow pay, etc., those are gone, and here's where they are now, and here's where they're headed. And so if you can paint that picture logically and where that it makes sense, that's where it goes into looking at the last 12 months of pay history, right? So if you have the worst credit score in the world, but the last 12 months that you've actually had credit, number one, you can't have bad credit and then not have any accounts whatsoever open, because that doesn't prove that you've learned your lesson or whatever, or gotten past that issue and moved forward. So you've got only 3 accounts now. You're conservative, but they've all been paid perfectly for 12 months. And we're going to go into sometimes off the credit bureau stuff like rent, like utilities, some different things. If we're really painting that picture of and it happens a lot of times for folks that are totally disabled rating, etc., that they had a lot of struggles with whatever it was that's part of that rating being 100%, and now they got got the medical ratings up to 100%. They've got the ability now to pay that they didn't have before. They've got that steady income, etc. Or maybe they had a job loss in combination with that, but now they've got a W-2 full-time job again, etc. And you can paint that picture. And sometimes it comes into the compensating factors of, not only are they paying good for the last 12 months, they've got assets now they didn't have before. So you can show that they've got $20,000 in the bank, etc. They're going to be able to make their payments. It's all about painting that picture when you get down at that low point. And you have to prove to that underwriter that I really have changed and I'm really able now to pay and willing, and I'm showing that in everything that I do. So
perfect. Jerry, I got a good one for you. We've actually, in fact, done an entire episode on this. So we only have about 15 minutes left. So you don't get to take 40 minutes to walk through this one. But people always ask, hey, VA is a zero down loan. Why do I need money? Why do they want to deposit? Why am I needing money? So how much money does an eligible veteran need to buy a home?
So one of the things I'm going to say is it's going to depend on where you're purchasing, because a lot of times the impounds, which is your taxes and insurance for that home, are going to make a big difference as to how much is being set aside for your escrows, right? And so that's the money that's being pulled together in order to pay the bill when it's due. So a lot of times I will say to most, gauge right around, depending on the time of year, anywhere from 2% all the way to about 3%. In total, right? Because of whatever the purchase price is. So if it's a $600,000 home, then obviously you're going to want to have a decent chunk of money set aside. If it's a $900,000 home, that's an even bigger chunk of money, because now you're going to have enough for those taxes and insurance that are set aside. Let's say 4 to 6 months that are set aside for the impound account. Then at that point in time, that can get pretty hefty. Right. And so a lot of times it really does come down to that. And so I will tell everyone, generally speaking, 2 to 3%. So if you're buying a $900,000 home and you're talking about 2%, that's $18,000. We're talking about 3%, is what, $27,000. So you just kind of gauge it based off of one, how much potential escrows you may have to collect. So play it safe, I will say, to most. Make sure that you're making sure that you have enough for at least 4 months worth of taxes, 4 months worth of insurance, just to play it safe.
So I'm gonna throw the follow up out there, Jerry. Cool. So you tell me I need 3%. I got nothing, but I got an 800 credit score and I make a ton of money, so I qualify. How do we get it done? Because my girlfriend spends all my money. I cannot save a nickel. Can't save a nickel. But you're telling me I need 3% for my zero down loan.
Yeah.
What are my options for?
That's where our partners come into play. It's either one of the two things. Either we go with our lending partners that give us some credit for a said rate that help offset some of the closing costs, or we negotiate that into the purchase agreement, right? Our realtor partners will negotiate to make sure that they get as much back. I mean, as it is right now, I'm working with a fully disabled veteran, 100% P&T. The wife cares for him. She works also. And at the end of the day, they don't have a ton of money to deal with, right? So if they're limited on their access to funds, and they can't afford that, what did my realtor partner do? They went out and actually negotiated the full closing costs to be covered, and even part of them buying down the rate in order to make it a feasible payment for them. So those are sometimes the big key factors that come into play when you are trying to help a particular family qualify for that purchase.
Randy, I think I cut you off. You had something to say on that subject?
No, I'm good. It's all good. So.
Okay, awesome. We've got about 14 minutes left, and I have 2 interesting questions. We're getting to the end of the year here. So a lot of people are out of the market, but want to be in the market. They have their New Year's resolution. I'm going to become a homeowner next year. I'm going to buy again. I'm going to refinance. So first thing, because we're all mortgage guys here, let's talk about this. So Randy, we'll let you have the first shot at this. What do you say when someone is asking, hey, affordability, the payment's too high, I need interest rates to go down, I need rates to be where they were 2 months ago? When you have someone that wants to know, hey, our interest rates are going to go down, is next year going to be more affordable for me? How are you advising clients?
So here's the big thing, and it kind of ties into what we just talked about. How much money do you need to go down? Is that right now in most markets? There's some markets that didn't apply, but most markets that I'm involved in are slow. So the days on market for the properties are long. And so what happens when the property's long day on market and you're the seller and your house has been up for sale for 90 days? Where are you mindset wise as far as being willing to negotiate, right? So at that point in time, that's a perfect time to do the seller concessions and to put this thing together, because you don't have, and some of us remember 2020, 2021, whenever there were 17 offers the second day that the house was on the market, it was sold to somebody. We're not in that market right now. And so when you ask for the question that you ask, you got to take that into account, in that the affordability may not be the big question. The question is, can I buy? And is there something there that's going to fit me that I can buy now? Because I would tell you, rate wise, and this is the crystal ball portion of that, is I thought we'd be lower rates today than we were. When you asked me a year ago where we would be right this minute, I didn't think would be where we are today. And I did that. That's an educated thought. It wasn't me just pulling it out of the air. I listened to Hammer and to Matthew G and to 4 different people every day, and everybody in that group of Spears, because when you listen to those 4 people, you're not just listening to them, you're listening to all the people that subscribe and that interact with those folks. Nobody thought that would be where we are today. I mean, of the 4 of us here, I'll tell you, I didn't think that. What about you guys?
Same boat.
Man, even Fannie and Freddie thought conventional rates would be in the 5s this year, and they securitize 75-80% of the loans in the US.
Yeah,
I mean, the experts, and you can go off rate experts, which the people on this call are going to pay more attention to, not the everyday home buyer. But you can watch even business channels. I don't care if you're watching CNBC, Fox Business, Bloomberg. All of them had the same opinions on rates, and we're all analyzing the same data. It just doesn't always play out that way. And like you're saying, you can make an intelligent guess, but it's still an educated guess. I don't care how much data you're analyzing, things can change in the market. And not to go completely off topic, but it also goes back to will rates go down? Hard to tell. Here's the data that we're presented with. Here's what certain experts say. Here's my opinion. That's what I always say. Here's my opinion, but I've been wrong in the past. Doing this as long as all of us have on this call, there's going to be times you're going to be wrong. But what I was saying is, going back to what Randy was saying, is, not necessarily focus. And Josh said same thing. People won't remember their rate. Now's the time really not to look at rate, but to look at your payment. Because yes, taxes and insurance can go up, but if you're in a 30-year fixed VA loan, that payment can't change. It can only go down. So if we're in a low demand environment like we are right now, and sellers are willing to negotiate and pay all your closing costs or even do a temporary buy down, the more important question, and not to ignore your question, Josh, in my opinion, is what is your payment goal? Because let's build around that budget. And then if rates go up, guess what? You're in a house that's going to appreciate in value with a lower payment than you would have got the following month. If rates go down and you're outside that 6-month, 210-day period, let's do a simple VA IRRRL and get that payment down. And it's like, lock it in. It's an insurance policy at this point that things can't get worse from your mortgage standpoint. So
I think that
go down, who knows?
I think that frames it perfectly. What I was trying to, my point is that we don't know what's going to happen. So I would focus on finding something that meets your needs and that you're comfortable with, that you can feel that you can afford, not qualify for, because in most 9 out of 10 of the people that I deal with qualify for a lot more than they're comfortable with. So if you're comfortable with it, if it meets your needs, then consider strongly doing it. I would say don't go out and find something that's really stretching and count on rates dropping, because if you're really stretched thin and rates drop and any of the shoes drop that puts you in a bad position, then that's a different animal than on what I'm talking about. But if it fits you and you're comfortable, then interest rates could go down, but they may not. So if you're not comfortable with what we're dealing with today, then yeah, you can hold off. But to understand, the other thing that for that is typically rents also mirror to some extent the same trends that you see. So if interest rates go up or stay the same, your rent is going to catch up to that. It may be that your landlord bought in 2020 when rates were, very low, and so they've got their numbers based on what they paid for it. But now rates are going up. They've got to refinance. They got to buy another property. They're going to raise that. It's not going to stay the same. So there's a lot of questions that come in. But I would say if it fits you and it's comfortable for you, then rate's not the biggest factor.
And for any of you watching at home, I kind of want to underline and just clarify what both of them said. When Mike's saying focus on payment, he's not saying, hey, I'm a used car salesman, I'm going to put you in a 10-year loan so we can stretch this out. It's saying know that payment on a 30-year fixed We're not doing a 2-1 buy down and hoping and praying that rates come down in the next 2 years. We're saying, what is a payment that I qualify for, that I can afford, that I'm comfortable with, that's on a fixed rate? That's what we're saying in terms of focusing on payment now versus interest rate. Because the LA Times ran an article like August, and it was all of these people who were sold this bill of goods that marry the house, date the rate. And they all did buy downs. They did crazy, goofy stuff. And they were a year, 18 months into it. And they're like, oh my God, rates never went down and we cannot afford this. So I mean, if you choose to do a 2-1 buy down because you're comfortable where that payment ends up, valid choice. But no one should be doing that going, oh my God, if rates don't do something over the next 12 to 24 months, I am not going to be comfortable in this, because we don't have any guarantee of what happens with housing prices going forward. Your ability to refinance, thankfully with the VA, that regardless of home prices, you should have the ability to do an IRRRL. But we don't know what's happening with interest rates. So when we're saying focus on the payment, it's not ignore the interest rates. It's where are interest rates today? Does that payment, is that something that my household, my family can comfortably afford and make? And Jerry, I didn't mean to cut you out of that conversation. Did you have some thoughts on?
No,
on
I'm actually right in line with what each of you said. At this point in time, it is more of the comfort level of where you're at. It's not necessarily rate, it's affordability, in my opinion, to what you can actually work and navigate through. At the end of the day, if you are comfortable with the payment, let's just say your DTI, or basically debt to income ratio, is well into the 50s, and you're really pushing that envelope, knowing that you're looking at an IRRRL down the road. Okay, like, I understand the dynamic there, and if it makes sense, okay, push it. But if it doesn't, and you're not going to be comfortable because you know that you have upcoming expenses, really decipher where your breaking point is before you walk into something that can ultimately kind of leave you in a position where you're kind of crash and burn, right? So ultimately, pay attention to the numbers. Make sure that where's your break-even point if you are going to look at possibly buying the rate down in order to put you in a better comfortable position, and see, can the seller contribute in this case in order to do that. Like I used the example of my current client, is they're having the seller pay not only their closing costs but also the rate buy down for them, and it's not a 2-1 buy down. It's just a simple rate buy down in order to make the payment more comfortable. And so those are the kind of avenues that we need to also be looking at when we're determining what is most important when it comes to the interest rate.
Perfect. We got about 5 minutes left. So with that, I kind of want to close it with this thought or this question and kind of go around the horn. Because like I said, we cover different parts of the country, basically from east to west, California here all the way to North Carolina, primarily the southern portion of the country, but we got a good geographic representation. So in terms of affordability, that's the issue for everyone right now. Over time, we don't run out of people who want to buy a home. The majority of Americans want to own their home, but can they afford it? So can they qualify, and are they willing to step forward and do that? So affordability, we talked about interest rates. That there's three things that impact affordability. It's wages, and wages generally go up slowly and predictably over time, 2, 3, 4% a year. So over 5, 10 years makes a big difference. In the next year or so, probably not going to make much of a difference for most borrowers. Interest rates can swing wildly and can make a big difference in the short run. We've seen that on the wrong side in terms of them running up over the last couple of years and staying elevated. The last piece of it there is home prices. There's no end of crash porn all over the internet of people telling you that tomorrow home prices are going to go back to 2008 levels and you're going to be able to buy for nothing. We've talked here on the show that many of the markets that we operate in are not strong seller markets anymore. You are able to negotiate. So with that, Mike, you're the furthest east of us. So in the southeastern United States, I know maybe tell us what states you operate in and what you're seeing for the most part for buyers in those areas in terms of purchasing and their negotiating ability in terms of getting concessions and good prices.
Gotcha. I'll try and keep this short, but I'm physically in Raleigh, North Carolina. My brokerage between me and my partner only cover North and South Carolina. We just cover that geographic area. But we're in a very competitive, just overall economic environment. What I mean by that is between just North and South Carolina, Raleigh, Charlotte, and Columbia, South Carolina are like three of the hottest markets for people moving here. Like I was just at a meeting last week with the Raleigh Mortgage Bankers Association, and when you factor in birth rate and people moving to what's called the Triangle area, which is Raleigh, Durham, Chapel Hill here, and Research Triangle Park, where there's lots of industries moving here, we're adding 99 people a day was the average for 2024. Reason I bring that up is we are seeing houses start to sit a little bit. It all depends on everybody. I wish we had a realtor on to back it up. Location, location, location. It all depends. Like you can go inside anywhere, like where you guys live in Southern California, where Randy lives in Texas, and you can go one town over and it's a whole different ball game and setup. But people are sitting out waiting for rates to drop. And when they do, those houses aren't going to sit anymore. But when you have low inventory and everything like that, we're not seeing prices decline. We're seeing some concessions. Like when I'm working with people who are doing conventional loans, we're starting to see more of those temporary rate buy downs. And we properly explained it to them, like you were just talking about, Josh, like you have to be good with this payment. This is just kind of a temporary solution to help you out in the interim. But long story short, we're not seeing a decrease in demand to where we're going to see prices start to plummet. There's just not enough inventory in here. And, you'll start to see some, like you were saying, clickbait on the internet. You'll start to see some panic. Like my brokerage is kind of slow right now. It's that time of the year. One, rates are still inflated. We just got through a very polarizing election, if nobody was paying attention. So people were sitting out for that. And we're going into the holiday season. So I think January and February, we're going to see a lot more people, regardless of what rates do, get out of what they want to do. Are they crammed into a house that's built for a family of 4 with 6 people? Are they over it? Are they tired of renting, et cetera? So we're not seeing any type of really issues with values dropping. And if there is a property sitting there, it was likely overpriced to start, but we're seeing those concessions that Jerry was talking about to entice buyers to get in there. So sorry, that was long-winded. Hopefully that answers your question.
No, that was great. So let's go from North Carolina over to Texas. Randy, when we see some of these reports that seeing a little bit of weakness, people love the poster child for markets that have lost a little bit in value from the peak is Austin. Austin was one of also the most highly appreciated markets. But many of the markets that have performed less well over the last few years are in Texas. So none of us are in Florida. But Florida, especially the southwest coast of Florida, has seen some price corrections. If you look at projections for next year, there are several markets in Louisiana, also on the Gulf Coast, expected to not do super well. But for the most part, 80% of the markets are experiencing appreciation and are expected to continue seeing appreciation next year. But how does that translate into the Texas market and what you're seeing, Randy?
So Texas has been a kind of the benchmark for stability as far as employment goes. There's a ton of businesses that are moving here, and that's been a big trend for 15 years easy. And so the market's been pretty steady, but on the same point in time, the days on market is much slower than it's been for several years. So other than some individual markets, like Austin's just crazy, always one way or the other. But the Dallas-Fort Worth is pretty stable. I see growth. There's days on market are longer, but I still see appreciation. I'm not getting appraisals that are missing the mark as far as that goes. So I would say that we continue to have slow appreciation. It's not crazy, but it's steady. That's what we're seeing.
Perfect. Jerry, so you're Arizona, California. Why don't you give us that look here and maybe more specifically Arizona? Arizona, like for Southern California here, especially for entry-level buyers. Some of the mid to higher tiers are softer, but the entry-level stuff, not hot, not competitive, flying off the shelves, but the Arizona market's a little different than that. Why don't you give us a little bit of that perspective?
Yeah, so it really just depends on the area of Arizona, right? Where you get into certain areas, certain communities, certain counties, I should say, where the dollar goes a lot further when it comes to some of these entry level homes, and really what it comes down to is the affordability in those areas because of the taxes, because of the insurance cost. It doesn't cost you a lot, taxes and insurance wise, in the state of Arizona for the most part, because you are looking at limited exposure to earthquakes, exposure to fires, exposure to basically thunderstorms.
Dirt doesn't burn, Jerry. Dirt doesn't burn.
Exactly. You don't get a ton of floods either. So at the end of the day, you'll have your monsoonal rains and stuff like that come through. But when you look at the overall picture, affordability is a lot simpler out there. And because homes are continuously being built out in Arizona, especially certain demographic areas, they are expanding rather rapidly, and it makes homes that have already been occupied. So resale homes are now sitting longer, and because of it, you do see that constant support from the sellers to get the homes moving off the market by offering those incentives. And with all honesty, I feel like a lot of it is very similar to California, except for the fact that the home prices are actually still quite stable and still quite low in Arizona in comparison to California. Even in the lower cost areas, you're still looking at homes in those lower cost areas being more expensive than you have in Arizona, which is wild. I mean, you're talking about a $200,000 difference, $300,000 difference, and there really isn't a big swing in the approach. It's the same type of scenario in my eyes. I see homes that are sitting 30, 60 days, and because of it, they're getting seller concessions, seller credit to buy down the rate, to cover your closing costs, sometimes to even help pay some of the debts that some of these veterans have in order to help them qualify. So again, in my opinion, there's a lot of different pockets, but it's pretty consistent.
That's a pretty good overview, and hopefully you guys watching at home, the most important thing, again, we don't have any of the vetted real estate pros on with us tonight, but wherever you're at, that is one of the most important roles that your realtor can play in terms of on specific properties, telling you the data for that neighborhood, for that specific property, how long it's been on the market, reaching out to the listing agent, finding out what's the seller's motivation, where are they at. And definitely, we mentioned that all real estate is local. Different markets around the country are behaving very, very differently. The Northeast, you may be still looking at a competitive situation where there's going to be 3, 4, 5 offers on any property that you want. If you're on that Gulf Coast of Florida, you may be the only one offering, especially if it's a condo. And there's a whole nother host of issues there. But rely on your pros. Don't base everything just off of price, especially on the real estate side, when now there's a negotiation in terms of what am I going to pay them if the seller is not willing to pay them. I get a lot of people go, I'm just going to go to the listing agent. Okay, at best you have a mediator there. So I'm not saying that we have the right answer or that there is a right answer, but don't undervalue the role of experts in your corner advising and helping you with that. So appreciate you three gentlemen, experts, being here and sharing your info tonight. We are going to be off for the holidays through the rest of the year. We'll be back in the first quarter with these pros and others going through topics that matter to you. So hope you all have a wonderful holiday season, great New Year's, and we will see you all, including you three gentlemen, in 2025.
Absolutely.
Thanks, Josh, and to all the people in the group. If we didn't get to your question, drop it in here or on the replay, and one of our wonderful moderators will answer it for you.
Absolutely. All right, gentlemen, Merry Christmas.
Merry Christmas indeed.
Merry Christmas, guys.